Welcome to this Daily Brief Explainer. Today, we're unpacking a dynamic that is literally reshaping global wealth. We're talking about the invisible drain, how global monetary policies are quietly, relentlessly siphoning away your savings, and the golden shield, how massive structural forces are frantically building a defense using hard assets. Seriously, if you have cash sitting in a bank account right now, you absolutely need to understand the macroeconomic forces we're about to break down.
Okay, let's dive right into this. 250%. That staggering figure is China's M2 to GDP ratio. And honestly, it's the perfect hook to understand the sheer volume of money just sloshing around our global economy. To put 250% into perspective, imagine a factory that produces $1 million worth of real goods every year, but somehow there's $2.5 million in cash constantly swirling around the factory floor. It is an astronomical amount of currency circulating relative to actual real-world economic output. But before we get into the fallout of that massive imbalance, let's quickly make sure we're defining our terms.
Just so we're all looking through the exact same lens, M2 is essentially the total global money supply. We're talking about the physical cash in your wallet, the funds sitting in short-term bank deposits, and highly liquid financial instruments like money market funds. Basically, it's the readily available money in an economy. And what's really crucial to grasp here is how invisible this categorization is to the average person. This is the money most of us mistakenly think is perfectly 100% safe. But as we're about to see, the speed at which this safe money supply is expanding is the very root of an invisible drain on your wealth.
To put that 250% ratio into absolute terms, consider these numbers. China's M2 supply just hit $53 trillion, while the United States is sitting at around $32 trillion. Now, trillion is one of those words that gets thrown around so often it completely loses its meaning, right? But think about it this way. If you were to count one number per second, it would take you roughly 31,700 years just to count to 1 trillion. And we are talking about 53 trillion of these units in China alone. This unfathomable scale of fiat currency in the global economy sets up a very, very serious problem: the massive degradation of purchasing power. Because when you inject that much currency into the system, its fundamental value inevitably dilutes.
What's truly fascinating and honestly a bit alarming about that massive 53 trillion figure is its makeup. An estimated 70% of it is actually citizen savings. So we're not just talking about corporate capital or government reserves here. This is the everyday wealth of everyday citizens, parked in highly vulnerable short-term instruments and bank accounts. They are literally sitting on a massive mountain of fiat cash. So the obvious question is, how exactly did so much retail wealth end up parked in cash in the first place?
Well, it's a fascinating and highly psychological progression. Historically, Chinese citizens invested heavily in real estate. They poured their life savings into bricks. But as that real estate market started to teeter and show classic signs of a pyramid scheme, sheer panic set in. People needed a safe haven, and they needed it yesterday. So step 2 was this massive flight to safety into bank deposits. They liquidated real estate and temporarily held cash. But holding fiat currency in a highly inflationary environment is a losing game. It's honestly like holding a block of ice in your bare hands and just watching it melt. So now, driven by this desperate urgency to protect their life's work, we're seeing step 3. It's a frantic structural pivot toward a golden shield. They are actively moving out of melting fiat and into physical gold.
To truly understand the scale of this pivot, just look at this single metric. In the month of May alone, China imported a staggering 163 tons of gold. That's equivalent to over 5 million troy ounces of physical gold flowing into the country in a single 30-day window. To give you a physical sense of that weight, 163 tons is about the same weight as a fully grown adult blue whale. Or think of it as roughly 80 large pickup trucks, all imported in just 1 month. So this isn't some minor fleeting retail trend. It is a massive structural accumulation of a hard asset.
And this brilliantly illustrates two wildly different global financial strategies happening at the exact same time. Those 163 tons of gold, they cost roughly $21 billion. So on one side of the globe, you have citizens and institutions spending $21 billion in a month to aggressively accumulate physical, tangible, real assets. And on the other side, you have the U.S. Federal Reserve injecting roughly $21 billion in fiat liquidity into the system in a month. One side is buying a heavy physical shield. The other side is essentially just printing more paper.
Building on this, we reach a really critical data-driven turning point. Look at the money supply growth rates. China's M2 is growing at roughly 8.6% annually, and the US M2 is growing at about 5%. But then look at global physical gold production. It's growing at only 2%, and that rate is actually slowing down. Fiat money is being printed endlessly and frictionlessly by literal keystrokes on a computer, while the production of hard assets remains strictly limited by the actual laws of physics.
Which brings us right to the invisible tax. If the global money supply is expanding by 5% to 8.6% every single year, and your wealth is just sitting there in fiat currency, you are silently losing 5% to 8.6% of your purchasing power annually. I want you to really think about what an 8.6% money supply growth means for the hard-earned cash sitting in your own bank account right now. If your money is just sitting there, not yielding at least that much in interest, you are actively moving backward. It means the absolute riskiest investment you can hold long-term might actually be a standard bank deposit.
Now, an astute observer of financial markets might ask a very fair question here. Wait, if gold is the ultimate shield against fiat debasement, then who on earth is selling their gold right now during these short-term market dips? It's a great question. So let's take a neutral look at the global market mechanics to understand where this downward price pressure is occasionally coming from.
When we analyze the sellers, a very distinct pattern emerges. It's temporary, circumstantial liquidation rather than a lack of faith in the asset itself. Russia, for example, is selling due to immediate, severe economic pressures and global sanctions. Certain Gulf countries and Turkey, they're selling specifically to fund massive energy and oil imports. They just need immediate liquidity for physical operations. Over in India, there have been periods where the government actually advised citizens to curb purchases to balance national trade deficits. So yes, these actions absolutely create short-term price drops, but they are purely circumstantial. In reality, they're just bringing the price of gold closer to its fair fundamental value, offering a pretty perfect entry point for the real, long-term buyers.
Contrast those temporary sellers with the massive, structural accumulators in the market right now. Chinese citizens are buying aggressively for bedrock wealth protection. Huge institutional buyers are stepping in heavily. Interestingly, governments are actually lowering regulatory hurdles for gold imports to facilitate all this, proving this isn't just retail panic. It's a sovereign, structural shift. The Shanghai Exchange is physically expanding its vault capacity just to hold more bullion. And parallel to this, we are seeing the exact same long-term, bullish structural trend in decentralized hard assets like Bitcoin. Make no mistake, the smart money is decisively moving toward assets that absolutely cannot be printed on a whim.
Let's shift our lens back to the United States for a second, because just like we saw in China, roughly 65% to 70% of the massive 32 trillion US M2 supply is utterly trapped in retail bank accounts and short-term funds. That means tens of trillions of dollars of everyday citizen wealth is sitting completely exposed, directly in the path of that invisible drain we discussed earlier. So the crucial takeaway here is this. Between 2010 and 2019 alone, U.S. deposits grew by an astonishing $3 trillion. The middle and upper classes have accumulated massive cash reserves. You might look at your bank statement at the end of the month and feel a real sense of security, because the balance has grown. But the physical reality, what happens at the grocery store or the car dealership, tells a completely different story. As the M2 supply continually expands at 5% annually, savers are silently being stripped of their purchasing power. The number in the account stays the same, or maybe even ticks up slightly, but what that number can actually buy shrinks every single year.
To understand why this monetary expansion happens so persistently, our sources point to a broader historical progression regarding top-down economic models. They trace the idea that elite global policymaking heavily influences these fiat systems. The source material highlights programs like the World Economic Forum's Young Global Leaders Training and points to a 2017 Harvard speech by Klaus Schwab, noting how these trained individuals are inserted into global governments. According to this analysis, these synchronized, top-down policies across nations prioritize continuous systemic liquidity over the preservation of citizen wealth, which ultimately drives the structural degradation of fiat currencies globally.
We'll leave you today with this highly provocative quote directly from our source material, summarizing the ultimate fate of traditional fiat systems. Cold coins are pure garbage. It's a harsh, unflinching assessment. But as we've explored throughout this explainer, when central banks and governments can endlessly expand the money supply with keystrokes, the cash you hold inevitably loses its strength. It forces all of us to deeply question the ultimate destiny of fiat currency in our modern financial system. If cold coins are pure garbage, what exactly is sitting in your wallet right now? Thanks for joining us for this daily brief explainer. Keep questioning the consensus, and we'll see you next time.